There's a myth about investing that funds tracking the index are safer than actively managed funds. The fact is, compared to some actively managed funds, investments that track the index could put your long-term financial objectives at greater risk. Why is that? Because they're programmed by a computer to do one thing: follow the path of the market 100% of the time. Up, down, or sideways. So when the market faces an inevitable decline, index tracking investments suffer along with it, all the way to the bottom, putting your financial goals at risk. An actively managed American Funds investment, however, is hand-built by American Funds' highly experienced investment professionals using our proprietary capital system. They design funds to hold up well during downturns and continually shape and guide them to benefit from market and economic conditions. This has put American Funds stock funds on a different path. So even if we sometimes lag during rising markets, when faced with a market drop, our U.S.-focused stock funds have tended to outperform the index, losing less during declines. This is known as low downside capture. A downside capture ratio of 100% means an investment falls exactly as far as the market did, while a lower figure means it did not fall as far. Low downside capture has helped investors stay on track with their objectives. Our fund's average downside capture ratios have ranged from about 69% to 97%. This has been instrumental to the superior long-term track record of American Funds stock funds, because holding on to more money in a down market leaves you on track and better positioned to benefit when the market rebounds. That's the capital advantage. Better investor outcomes by losing less during downturns. When it comes to risk, why not position yourself for a better financial outcome? Now let's look at the power of low downside capture in action with the Investment Company of America Fund. Although past results are no guarantee of future results, this example over a 20-year period reveals the real-world long-term benefits of losing less during downturns. In the late 90s, very strong markets led up to the tech bubble. During that stretch, the fund was actually trailing the S&P 500 Composite Index. But then something remarkable happened. The tech bubble burst, and the market lost nearly half its value. But the fund demonstrated low downside capture, falling less than 29%. The tables turned and the S&P 500 began trailing the Investment Company of America. Having held on to more money, fund investors were in a better position when the market turned around. As you can see, while the index investor needed a gain of more than 90% following the downturn to be made whole again, a fund investor needed a gain of only about 39% to fully recover. Retaining more and staying invested kept investors on track to build greater long-term wealth. Jump forward to the crash of 2008, when the market lost more than half its value. Once more, the fund held up only slightly better, but thanks in large part to its performance during previous downturns, its long-term investors were on a better path to meeting their financial goals. Throughout the 20-year period, the fund captured about 92% of the market's gain, but by falling only about 76% as far during major declines, it delivered better outcomes. As you can see, a fund investor would have accumulated considerably more wealth than an index investor. Indeed, over its 82-year lifetime, the Investment Company of America has captured just 89.3% of market losses, thanks to the capital advantage. To learn more about how our U.S.-focused stock funds can help you manage risk, visit our website at